Welcome to Part 3 of Auditing Standard number 5. AS5 has over 100 pages, which is really daunting for the layperson. I'm going to make it easy to understand. It's the Cliff Notes version, essentially. In this session, we cover using the work of others and materiality. This training gives context to SOX 404 requirements. It's meant to be an easy to understand breakdown of dense words, and because the literature, there's so many parts to the literature, I have broken it down to smaller parts, part 1, part 2, and you can see here, based on your focus or the areas you're interested in, you can then listen to selected parts. And it's meant for people who need a refresher, or if it's your first time exposure to SOX 404, you can then get an overview. This table of contents came directly out of Auditing Standard 5 from the PCAOB. I've just made it into chunks so that it's easier to understand and follow. Using the work of others. This section is really important because this applies to SOX service providers, it applies to internal auditors, it applies to everybody who is not the external auditor. So what I've done is I've also highlighted key sections more for emphasis so that you can focus on it, and I'll talk about it in a little more detail. Paragraph 16 just highlights, if you want to know more specifics and granularity, there's the auditor's consideration of internal audit function in the Audit of Financial Statements. So if this is something you want to learn more of, you can actually go there and read about it. But paragraph 17, it basically says that the auditor, you can actually use the work performed or received direct assistance from internal auditors, from employee personnel, from the company's personnel themselves, in addition to the internal auditors, whether it's a finance person or in other parts of the organization, and third parties working under the direction of management or the audit committee. So again, it allows external auditors to rely on our work. And the next section talks about under what circumstances. So paragraph 18 says that the external auditor can assess, in order to rely on the work of others, you have to assess the competency and the objectivity of the work that you're getting. The higher degree of competence and objectivity, the greater the external auditor can use it, can use the work. And that's why as a SOX provider, an outside party coming in, and if we are directly engaged by the audit committee, our work, number one, is already objective. Right? It's a higher degree of objectivity. If we were an inside employee that reported to the CFO, well, if I work for the CFO, of course I wouldn't want to tell you that my boss is cheating on the financial statements or doing something illegal. There's a lot more pressure because you are part of the inside circle. And then there's also the competency. And this is where in the note, it talks about what competency means. So the note here says, for the purpose of using the work of others, the external auditor has to address competency. And competency means, do they have the skills, the knowledge? So number one, getting the skills and knowledge, maintaining the skills and knowledge that enables that third party to do the work well, right? And they use the word perform ably the tasks. So number one, do you have the understanding and have you kept up on the knowledge and the expertise to do the work? That's the part of competence. And the reason I highlight different colors is because I wanted to separate certain sections. Also related to competency is, in order to assess competency, the auditor evaluates the factors about the person's qualifications and their ability to perform the work, right? So qualifications, whether it's your training, your education, if you have a CPA license, if you've had the accounting background, the auditing, and if you work for a firm like ours, where we've got lots of training, and even if you didn't have specifically an accounting background, the qualifications, the experience. If you've been doing SOX for many years, even if you didn't have an accounting degree, but you understand accounting, you have practical application, that works as well. Now let's talk about objectivity. Objectivity, they define it as the ability to perform the task impartially and with intellectual honesty. Impartially. If it was because we are an outside party or whoever the work of others, if they're an outside party, they're more likely to judge the work with objectivity, meaning not be swayed because, oh, my next promotion is dependent on whether I find mistakes, or if I see errors that you've performed and I highlight it, maybe you won't like me as much as my boss, maybe my performance rating. And then the intellectual honesty is really not being biased that, oh, of course it's my boss, so of course the work is reliable. And in order to assess objectivity, it says the auditor should evaluate whether the factors are present that inhibit or promote the person's ability to perform the work, which means that are there certain things that would make it, in order to be objective, if I was looking for a promotion in my organization, of course I'd want the results for that organization to be quote-unquote clean. And so the factors that would help me, that incentivize me to sweep things under the rug or to ignore certain warning signals or to go easy on a particular person because I personally like them, that's part of that objectivity. And it also then talks about don't use the work if they have low degree of objectivity, regardless of their competency. So even if you are the most qualified auditor, if you are auditing your boss, there's zero to little objectivity. And the reverse is true in that a person can be completely objective, but if they don't have the right training, you can't use their work. So if you pulled someone, if someone came from the manufacturing line and they're completely objective, there's nothing tied to the work that they're reviewing, but they have no background, no training on how to audit or the risks that they're auditing or the level of documentation, well, again, you can't use their work, you can't rely on it. So essentially you have to have high competency and high objectivity. And the extent to which the auditor can use the work of others really depends on the risk being tested. So for a lot of the Big Four, some of their policy is they can rely on the work of low and medium risk areas, but for the high risk areas, as a policy, it doesn't matter. Only the external auditor's work is what they're going to rely on for their opinion. Other audit firms will say, you know what, we're going to judge it, and depending on the circumstances, we may use it. This essentially just gives the auditor the ability to determine how much of the work they can rely on. So now you know why using the work of others is so important to us, particularly as an organization that focuses on outsourcing or co-sourcing SOX with our many big clients and small clients, and why we want to understand the objectivity. And sometimes many of us have been asked, can you give me the resumes or the bios of people performing the work? The external auditors have asked that, and that's why it's important for them to see if someone's been doing it for 10, 20 years, if someone's gotten the degree in it, do they have experience that's similar to it that the auditors can rely on. That's it on using the work of others. Let's talk about materiality. You'll love this section. This is it on materiality, one paragraph. But it actually is a good hint for you. It is so important that the PCAOB called it out on its own, this one line. In planning the audit, the auditor has to use the materiality that they would use in the financial statement audits. That's all that says. Same materiality. Now, the rest of it, the PCAOB has kind of left open to how do you define materiality. And as you will know, we actually have built out a template that 99% of the industry continues to use. I mean, across the board, there aren't so many ways. Materiality has now been defined as 5% of either revenue, total assets, EBITDA, depending on the type of company and the industry. What are the typical metrics? If you are in property management, for example, NOI, net operating income, is the metric that you would use, and so maybe it's 5% of that. If you're a revenue company, it's revenue, right? It might be net revenue, it might be gross revenue, depending on your business model, but it's essentially saying materiality, everything that we do, we have to put it through a filter. And again, going back to AS2, where it didn't really discuss materiality, you had to test petty cash. Well, now it's saying use materiality and use the same number that you're using for the financial statement audits. It's really complex when it comes to the application and when you argue with the auditors what's material. Sometimes it's not just the numbers. Materiality also has to do with who the stakeholders are. Are people looking at revenue versus EBITDA? And by using those different metrics, you get different numbers, and there's judgment involved in how what numbers you use, and there's a little art and finesse to it. That's it.